Hey everybody, it's me, the Unsigned Wall Street, from the balcony at the New York Stock Exchange. I'm here with no other than JD Durkin of Taking Stock. Amazing. JD has worked at every media outlet on earth virtually, you know, going back from being government representative for Cheddar back in the day to working at Cheddar afterwards. He's been at the street, he's been everywhere. And Taking Stock is actually a new sort of media conglomerate here on the floor. It's some of the internal exchange. It's sort of a mixture of fintech and Cheddar and all that kind of stuff. And it's great because he really gets his hand in absolutely everything. He gets to interview some really smart people here on the closing bell, on the opening bell, and gets really to take the temperature from a wider, you know, look, when I speak to you, it's my opinion, and I try and share with you, whether it's Dan Ives or whatnot, but JD gets a really good temperature from so many different people, economists and traders and, you know, everybody in the biz. So, JD, welcome. It's a pleasure having you.
My man, thank you for having me.
Okay, so we're here on Friday. It's been a rock and roll week altogether, and you've seen, you know, you've talked to a lot of people this week, and we know there are a lot of opinions. You spoke to Katy Perry, right, who had an opinion about what was going on with the government shutdown and with earnings. You had a number of other people who are super smart who you've interviewed. What's your tack on what this week was all about and where we go from here?
Yeah, I think overall what I hear from people I talk to is that the AI hype is still here. There is concerns about a bubble, and I think that conversation's happening a lot more. Of course, the difficulty with a bubble is you don't exactly know when it pops, if it deflates, what it looks like. You don't know at some point if and when this bull market comes to a close, but we just celebrated the third birthday of this ongoing bull market. And you know better than anyone, every bull market at some point invariably will have a bear that follows it. It becomes a timing game, right? But as
Markets
we know,
go up until they don't.
And as we know, in the long run, it's about time in the market, not time in the market.
Right.
But I think that enthusiasm for the AI trade is still very much there. But there are more questions on the macro backdrop as interest rates continue to come down. What does the state of geopolitics look like?
Right.
How sustainable is a lot of this big AI data center spend for the giants? And I think a lot of uncertainty, but it's still kind of eases the runway for the markets to have some running room here for what is seasonally still the very strongest part of the year here in Q4.
And you know a lot more because I haven't really looked at it earnings-wise. How did we come out of the gate with the big banks, and what did yesterday's significant shakedown of the regional banks show us?
Yeah, it reminds me of the bigger conversation we've had, the so-called bifurcated economy, the difference between the haves and the have-nots. In a high interest rate environment, the pressures on the economy after COVID, we've had a great separation where if you're a saver, if you're a big institution, you've done very well, oftentimes at the expense of smaller institutions or individual borrowers. And I think we saw that this week with the big banks. The big banks do have very strong reports at the gate, and that was the narrative Monday, Tuesday, when we got to the Western Alliances of the world, when we got to the Zions Bank Corps of the world.
Those are regional banks for you, those of you who don't know.
And the ones that therefore have more exposure to Middle America, that maybe there are some bad losses on the balance sheet. The companies had to
the companies per se, but that would be based on people's inability to, is that you think an impact of tariffs that people are starting, the consumer is starting to see its inability, their costs going up, and that means that we'll start weighing, look, when people who are living paycheck to paycheck or even the next level up from there, their costs go up, they're going to pay Sam to pay Paul, right? They're going to take money from one place to go to the other place. And look, sometimes credit cards are the one that tend to suffer, and so they're not paying their credit cards on time and or defaulting, right? And so they're not growing; they're sort of constricting.
Yeah.
And so what was the narrative around the regional banks?
And then you had another category of the American Express as a higher income and inherent consumer. Those consumers are doing great across the economy, but oftentimes it's the lower, more moderate income American that are still feeling the squeeze. We're still in a high interest rate environment. Yeah, we talk a lot about cuts, and we've had a couple of cuts, but we're still far elevated versus where we were before 2022. And I think we'll continue to see that pressure point on those Americans. But given how important consumer spending is, 70% of our overall GDP, maybe there's some evidence of some cracks showing for the U.S. consumer, despite all of the optimism. And we can't forget, Stock market is one thing. It's not necessarily the economy. There is a correlation, but the two are certainly not the same.
But they very often, think about it, because this market is being fueled by the 1% of the 1%, right? People are living paycheck to paycheck. If they're employed, they hopefully will have a little bit of a 401k, but their exposure to the stock market is obviously not as they've not participated in that rally. So that when the economy tends to sort of flatline or start to shrink a little bit, they're the ones that tend to suffer. Government shutdown.
Yeah.
Curious. Had no effect on the market at all. Do you see that as odd? How do you relate it to past almost shutdowns? Because we haven't had that many shutdowns. And how do you see this continuation of a closure of the government start to affect the market down the road? We're in week 3.
Yeah, we haven't had many of these, but we have had a disproportionate number while Donald Trump is president. That's just a fact. And I think there's different reasons for the way that he approaches politics, the way he fights with Democrats, the unwillingness now of the other side to work and kind of come to the negotiating table. And there's no shortage. There's lots of agendas and there's lots of finger pointing and there's lots of political theater. We did have a 35-day shutdown a few years back. I think in this particular shutdown, as is always the case, I don't think the markets will pay attention until they really have to. Now when there becomes a threat at some point of knocks against GDP, knocks against growth, because of a lack of federal government funding, that's when I think Wall Street will start to pay attention a bit more.
So Besant said in the beginning of this shutdown that if this shutdown stays as long as 3 weeks, it could have as much as a 1% impact on GDP. Now, I know from week to week, month to month, when we hear PPI, CPI, CPE, all these numbers, jobs growth, unemployment, when we see as much as 0.1% shift or difference from our expectations to reality, the market has an aggressive reaction to it. A 1% change in GDP based on the fact that the government continues to shut down could be and will be a huge effect.
Yeah, absolutely. And the point about economic data is another big one, right? I mean, you talk about corporate earnings being the lifeblood of the market. Well, look how closely we pay attention to the PCE prints, the PPIs, and the CPIs.
And we're not getting any of that.
We're not. The good news is we are expecting to get some version of a CPI print next week because it's tied crucially to the cost of living adjustment for Social Security recipients. So the government's sort of sitting there saying, all right, well, we know we have to get out that one bit of data point, but we don't know how anomalous or different it may be from a traditional type of CPI print. So it gives us a sense of, we go lily pad to lily pad, but now the government's removing a bunch of those lily pads. We don't exactly know what the next step is. By the time we get the government funding back on the rails, we'll have a bit of a backlog of economic data, and by the time we get that information filled in retroactively, we could be surprised at the state of things and how it's looked as this shutdown continues.
Isn't it funny in a world of AI that the numbers, that economic data is still being based on 600 surveys or all that kind of stuff, and that even in a world of AI with the government shutdown that we still can't get that information, which is so powerful. And we even know that we had that year-over-year adjustment number that was so far off from what we knew. It was 880,000 shares, 880,000 jobs less that were actually produced or were made than we thought. I mean, that's kind of crazy. Doesn't that seem odd to you?
Those are wild revisions. We oftentimes get pretty wild revisions.
Yeah, we do.
And the nature of a lot of this economic data, of course, is that it's lagging data, right?
Yes.
And the challenge for the Federal Reserve is, I always think of the Fed as trying to drive a car this way using only information in its rearview mirror. That would be nearly impossible for any of us to do. The Fed is doing that for the globe's largest economy. And so despite the criticism of the Fed, the whole transitory flat back in 2021, 2022, the criticism of Jay Powell, for the most part, this guy has stuck the so-called soft landing, right? It has not been perfect.
100% growth since COVID, through COVID. He's kicking ass in my book. I don't care what anybody says.
And now we've got these renewed conversations over Fed independence. Obviously, the president is very, very much saying the quiet part out loud. He wants people that are going to be dovish in his sense to have those voting positions at the FOMC, pulling out charges against the Lisa Cooks of the world for allegations of mortgage fraud.
Just so you know, there's supposed to be no disrespect or politically incorrect statement, a Chinese wall between the Federal Reserve and the president, right? And the executive branch, I would say, right? And we know that Mr. Trump does not, he looks over those walls.
Yes.
Right?
He'd like to bust down those walls.
Yeah, he does, and he doesn't pay any attention to those rules. And think about it, they're there for a reason, right? His economic decisions are economic data-based decision-making that are super sensitive based on a lot of information. and it can't be politically based. It can't be anything based but the economy. Right? And we saw that, especially with the pressure that he's been given over the last 4 months, basically told, you better cut rates. And we know one of the reasons he didn't was Mr. Trump is not an economist. Jay Powell is. And the bottom line is we were in a state of low growth or no growth environment with tariffs, right? Prior, in 2024, we were able to cut rates 1 basis point last year. We waited till September. Maybe we missed an opportunity, but we cut them because when you cut interest rates, when you're in a growth environment in the economy, then it's like pouring gas on the fire. Oh, yeah. But when you're in a low or slow growth environment in the economy based on tariffs are a tax, it's a cost that was not there before, and you cut rates, apparently it's an economic phenomenon that you get stagnation, right? You get high unemployment, high inflation, and no growth.
Right.
And there's no real Band-Aid for stagnation. There's no secret bullet, right? And you kind of just have to meander your way through that. And that's why Jay Powell held his ground until the economic data showed him that it was time to cut. And so I think that's important for people to know. So where do you see us going from here? I mean, there are a lot of moving parts.
There are a lot of moving parts, but it sets the stage for, I think market participants are still expecting 2 25 basis point cuts, one later this month in October, one for the December meeting, but without a Fed with a Fed that does not have that crucial data. They like to say they're data dependent. Right. It's a little more difficult to kind of know exactly what that path looks forward. But I think overall, there still seems to be a lot of enthusiasm for the general deregulatory story, a more favorable business environment. The number of business leaders I talk to who say the general space of mergers and acquisitions is a lot easier under this administration. Like things in D.C., a lot of those guardrails have been somewhat lifted despite the overall backdrop of uncertainty that maybe this administration has helped usher in.
Right.
I do hear from a lot of business leaders to say the overall conditions for us to do business in the way that we do are in many ways easier now than they were this time last year.
And if you speak to people on the right side of the beam, that was one of the things that was one of the most favorable things they would talk about with Mr. Trump, is the deregulation and the ease of mergers and acquisitions and business practice. Look, we know we have a 25 basis point. Maybe we're going to get 50 more. Maybe we're going to get a 50 and a 25, which will mimic last year. Wow. You know, what industries, what sectors do you see that catalyzing to a better place? I know, obviously, higher interest rates for longer affects housing in a big way, and real estate. And so do you see that I know 25 is not going to really jumpstart anything, but it should start getting people back to work in housing. It should basically, that's been very stagnant, right? And so hopefully, do you see that sort of changing?
Yeah, you want to see that easing on the 10-year borrowing rates, the 30-year borrowing rates. But I think look at financials, look at the insurance companies, any of those sectors that are particularly interest rate sensitive, right, in terms of just easing those overall borrowing costs across the economy. But it is a wild time and a wild ride to cover these markets. And as we got a reminder last Friday, hey, we thought that knee-jerk reaction from market participants was a thing of the past. We thought in April, when we had the Liberation Day sell-off 20%, right? We officially hit a bear market intraday on that Monday of April. We got a stark reminder last Friday that we're only ever just one tweet away from a 2.7% sell-off. And so, we've somewhat stabilized the ship since then, but we're only ever just one post away from a whole new storyline.
Awesome. So look, we're painting a picture of a market that, look, is the market going to go up or down? Yes.
Yes.
And that's a guarantee. And you know what? Is there going to be a 7? Look, we talk to Dan Ives very often. Obviously, it's our tech guru, and he believes that we're still in the second inning. Maybe now it's the third inning of a 9-inning game going into extra innings in the AI revolution, right? And that there are trillions of dollars in CapEx being put into that market. And we've seen I just heard the SoftBank CEO the other day say that NVIDIA, which was a $108 stock in 2023 February, a $900 stock in February 2024, in June it was $1,200, split 10 for 1. It's at $180 now post-split. He still believes it's an undervalued stock based on the demand over the next 5 to 10 years for data centers, for chips, for GPUs, for AI. And that's extraordinary. And what we're seeing as a result of that is a complete monopolization of the supply and demand space in this GPU mode. I spent the day yesterday with a guy named Andrew Sopko. He owns a company called Batch. It's a AI logistics trucking company. He's starting a new company called Agentum, which is basically, it's really genius, and you should actually interview him. He's coming next Thursday. Basically what it is doing is, it turns out, so what we've seen with Microsoft, Oracle, Google, Meta, all those guys are finding a way. They're going to have a demand in their organizations for GPUs and for AI. And so what they're doing is they're trying to lock down the supply that we know is very limited on the GPU side, because we know the NVIDIAs of the world have sort of glomped that stuff up, right? And so that's why we're seeing people secure supply, like the ChatGPT, AI, all the different mergers we're seeing.
Huge.
That is a way for the major players up here to lock in a relationship so that when they need something, they're going to get it. What does that do? That leaves out a whole, probably 90% of the population that will have a demand for GPUs, apparently there are what are now being called GPU entrepreneurs. So throughout Europe and India, there are, so as people can be Bitcoin miners, that people can mine Bitcoin on a small level, and they're literally in their basements, right, and create Bitcoin. So be it that they can create GPUs, and it turns out that there are all these small GPU entrepreneurs who are creating a supply, right, for GPUs. Obviously, look, if I need GPUs and I have a demand for AI, I've got to sign a 2-year deal with Google for $2 billion. There's nobody out there to sell me. It's like going to the farmer's market. There's the guy who just sells 100 bushels of tomato or nothing, right? There's nobody there to sell me. I've got a small restaurant. All I need is 1 bushel. Nobody's out there to sell that to me. So imagine there's a whole demand center. There's a disconnect. So what Andrew Sopko is, what Agentum, I believe that's the name of it, he's putting together under a marketplace all of these small producers, suppliers of GPUs that are all over the world. Now imagine I'm a person who needs GPUs, and I'm a small guy, and I can't sign that big deal. I'm going to want 8 hours or 10 hours. This is the way it works. I heard about it yesterday. It's actually fascinating that there's a whole level of people with a demand, and there's suppliers of small amounts, and there's a demand of small amounts of GPUs to get into the AI space. If you don't understand what I'm talking, check it out, because that's what it's all about. In order to engage the whole AI thing, you need GPUs.
Yeah. Either you mine the gold, or you sell the shovels for others to mine the gold. We're seeing a lot of those companies pick one of those two.
Exactly. So imagine that all these people who are going to be with small demand, that if you put them under an umbrella, and the small supply, and you put them under an umbrella, and you connect them, there's a business that could be even bigger than the bigger players. And so that's what his company is. It's an AI, what they call a compute marketplace for all these small demand and small suppliers to interact.
It's a new age industrial revolution.
Yes.
I just, in my role as a journalist down here, can never forget, I always think first and foremost, if my mother has the question about the markets, then someone watching at home has the question. As exciting as all these deals are, as exciting as it is for the 1% of the 1%, these things cannot come at the expense of the average everyday American who is struggling anywhere throughout the country. And I think part of my goal and part of my focus is always, hey, it's great to cover these stocks. It's great to cover these deals. We always need to have a finger on the pulse of what's happening for the average mother, the average father, the average American working in the day-to-day economy, because it's a fundamentally different story for all those for all
the
those
big
people.
guys. So that was what this was almost. He's calling it a democratization of the AI GPU experience.
Oh wow!
And so he's basically seeing a demand, seeing an opportunity, and taking advantage of it. And he's a genius. The guy's just incredible. He's done what he's done with AI logistics and trucking. He started doing that during COVID when the country was shut down, right? People were not buying, they weren't selling, there was no shipping, and no one knew how to get from here to there to A to B. And to the point where the trucking industry, they were offering truckers $165,000 base salary to get in the truck and drive stuff from here to Wichita. That's where that UPS, right? There was that period during COVID where they had nobody to drive the trucks, and they were offering outrageous sums of money. It became a whole nother industry. And so he was a big part of that, spearheading that thing during COVID. This is his new baby.
Yeah, one thing, if you don't mind me saying, to maybe encourage people to research if they don't know much about Dow Theory, since you mentioned UPS, we always historically look at the relationship between the transports and the industrials, right? The companies that make versus the companies that take very old trading technical Dow Theory. This goes back well over 100 years. I think once again, we're going to talk a lot more about Dow Theory to make sure that
what is actually the theory?
The theory in theory is that you could look at the way that transports perform, a basket of transports and a basket of industrials, and make sure they're all moving the same way, and that you don't have a misbalance between we're making the stuff, but do we have a way effectively to transport it as well?
Because if we make it and we can't sell it and we can't get it there, it's meaningless.
It only benefits part of all these publicly traded companies. So
Correct.
Dow Theory kind of looks at the way that both of these baskets of sectors of the economy work together. And I'm hearing a lot more chatter again about Dow Theory. In the heart, the advent of all these deals and the M&A activity and the AI data center spend to make sure that we've got both of those crucial things still working together. And that's Charles Dow, well over 100 years ago. And here we are. What's old is new again here on Wall Street. And that's why it's always important.
And the ingenuity of the young minds are extraordinary.
Oh, yeah.
If there's an idea out there, someone's thinking about it and someone's trying to figure out the solution.
Always.
Anyway, always a pleasure to talk to you.
Thank you for having me.
I think we've covered a lot here. And you know what? That's all I got to say about that.